Right. Good morning, everybody. Good morning. Good morning. And a very warm welcome to our interim results presentation. Thank you very much for coming. As ever, we've got a very full agenda for you today. We're going to talk about the markets, we're going to talk about our activities in depth, and then we'll have the full team up on the podium for you to ask questions to later. But let me first of all start by giving you my overview. And once again, we have produced some very strong first half results. The valuation was up 8.9% and development properties up 13%. ERVs were up 3.6% in line with our guidance in May, and our total property return was strong at 10.5%. NAV was up 11.8% over the 6 months, or more than 30% since last September. And looking at our performance compared to IPD Central London, for the year to September, our inline total return was held back by our lower relative income as we develop, but our capital return continues to outperform. And measured over 5 years, since the depths of the recession, we have built a sizable lead against our benchmark, some 21.5%, as you can see here. Now, to show the relative, I've set Central London IPD to 0, shown by the orange line. Our investment portfolio, shown by the grey line, has outperformed IPD even without the turbo boost to returns from investing and developing. So add in developments, acquisitions and sales to get a like-for-like comparison with IPD, and we've delivered 109.3%, as shown by the blue line, against IPD Central London at 87.8%. So then our successful strategy is delivering across the group. First, we're delivering strong development returns, making progress throughout the programme. During the first half, we completed 2 schemes, and they made an average 55% profit on cost. We started 3 new projects, including Rathbone Square. We replenished our near-term programme, and it now totals 0.6 million square feet. And we've added another 0.3 million feet to our longer-term pipeline, bringing the total to 2.2 million feet, 71% of which is in the supply-constrained West End, and giving us an outstanding platform into the 2020s. Second, we've continued leasing ahead of plan. We secured 9.7 million in new rent, 3.1% ahead of March ERVs, and our rent roll is up 7.8%. And there's more to come, with 21% of reversionary potential. And we've started the second half well, with 7.2 million let or under offer, 5.6% ahead of ERVs. Third, our accretive recycling is also adding to our performance. In May, we said that we would be net sellers again this year, and so far we have been. We sold 337 million of property at a 10% premium to book value, and we bought 2 properties for 21 million, both adjoining existing GPE holdings. And fourth, our financial position is as strong as ever. Our average interest rate remains one of the lowest in the sector at 3.6%. We have good protection against rate rises, with 92% fixed or hedged, and with 22% LTV and 508 million of cash and undrawn facilities, we have plenty of capacity for expansion. So all in all then, another strong performance and a business in great shape. And there's much more to come. 5 reasons why. First, market conditions remain supportive. We expect rents to grow. Second, our well-timed development programme will deliver material further surpluses. Third, our investment portfolio is full of potential for us to capture. Fourth, our disciplined approach to recycling will deliver healthy profits. And fifth, our financial strength will allow us to exploit these opportunities to the full. So then, throughout the rest of this presentation, you'll hear how the next few years for us will be all about maximising organic growth through investing in our exceptional portfolio. And let's start with the financial story from Nick.
Thank you, Toby. Good morning, everybody. I'm pleased to present another set of strong financial results with continued NAV growth and our most recent refinancing further enhancing our firepower to deliver more organic growth. So let's take a look at the highlights. The group's property portfolio rose in value to almost £3 billion, up 8.9% on a like-for-like basis. EPRA NAV per share at 636 pence is up 11.8%. The group's triple net NAV increased to 614 pence, and pro forma loan to value is low at 22%. Looking at the income statement, EPRA PBT of £21 million is up 16%. EPRA EPS increased 11.3% to 5.9 pence, and we have declared an interim dividend of 3.5 pence, up 2.9%. Now let's look in more detail at our NAV growth. Starting from our March 2014 EPRA NAV per share of 569 pence shown in grey, the main drivers of NAV growth were a rise of 37 pence from revaluation of the wholly owned investment portfolio and a further 14 pence increase from JV investment properties. Our current development properties boosted NAV by 12 pence, with our trading properties up 5 pence, being the residential at Rathbone Square. As shown in the pie chart, this total portfolio valuation uplift of 68 pence includes significant contributions from our East End of Oxford Street holdings in orange, representing 21 pence of the increase, and our holdings in the City, Midtown and Southwark in the blue, providing 17 pence of growth. Returning to the walk, EPRA earnings of 6 pence also enhanced NAV. The final dividend of 5 pence reduced NAV, and other movements of 2 pence gives NAV per share of 636 pence, up 11.8% over the first half. Turning to profits and comparing PBT against £18.1 million for the same period last year. Rental income from our wholly owned properties marginally reduced by £1.1 million given our recycling activities. As expected, our fees from JVs were £1.7 million lower, following successful completion of the GRP-owned 240 Blackfriars Road development and the conclusion of GCP's activities last year. Our share of JV profits reduced by £2.2 million as increased property costs and partner loan interest outweighed strong rental income growth. Group property costs, including voids, were £1.8 million lower, and admin costs were broadly flat. Our net finance costs reduced by £6.2 million as lower cash interest costs combined with increased capitalised interest. Overall, PBT of £21 million represents a 16% increase on the same period as last year and a 3.4% increase on the 6 months to March 2014 shown in yellow. Looking ahead, we maintain our guidance from May that EPS will likely remain broadly stable for this financial year, and we again expect dividends for the year to be fully covered. Now turning to our strong financing position and starting with our debt maturity profile at the period end. As we highlighted in May, refinancing our November 2015 maturing £350 million revolving credit facility boxed in red was one of this year's priorities. Following very strong levels of bank support and taking advantage of attractive market conditions, we have now replaced both this facility and also our February 2017 maturing facility with a new £450 million unsecured RCF. We have achieved a material reduction to the initial margin, which is now 105 basis points, and we understand the lowest achieved by a UK REIT since 2007. Together with lower commitment fees, this will deliver around £2 million of annual cash savings to the group. The facility has an initial 5-year term, which may be extended to a maximum of 7 years. And if extended, this would take the maturity out to 2021, further enhancing our debt ladder and financial flexibility. Moreover, this refinancing and our post-period end sales means we have more than £500 million of cash and undrawn facilities to fund further organic growth and other opportunities that may arise. Our excellent liquidity position is complemented by debt metrics which are as strong as ever. As the chart on the left shows, group interest cover has further improved to 7.1 times. The orange line shows the group's weighted average interest rate, which remains low at only 3.6%, which would further reduce to 2.9% if we were to fully draw our new RCF. And with 92% of our drawn debt fixed or hedged, we have significant protection against any future increases in market interest rates. Turning to balance sheet measures on the right. Net gearing and LTV have trended down over the last couple of years and were 30% and 25% respectively at period end. Pro forma for the sales of New Fetter Lane and our residual interest at 100 Bishopsgate, more on both from Toby shortly, our metrics are stronger still, with LTV reducing to 22%. And there's more information on our debt book, including the detailed terms of our new facility, in the appendix. This balance sheet strength means that we are well positioned to fund our exceptional development programme. Shown in orange, CapEx to come at our committed schemes stands at 262.8 million, up from 54 million at the start of the year, in large part due to the addition of Rathbone Square to our committed programme. The overlay in green is our share of the uncommitted CapEx of 226.3 million at the 8 schemes which we could commence in the next 24 months. This gives a total potential CapEx spend of around £489 million, all of it focused on schemes within walking distance of a Crossrail station and 95% on schemes in the West End. Pro forma for this investment, LTV would rise to approximately 32%, but that's before considering the development surpluses to come and potential receipts from recycling. If we then factor in the estimated £260 million of residential sales proceeds still to come from Rathbone, where we have already exchanged sales on 78% of the apartments by value, LTV falls to around 26%. This development expenditure is expected to deliver very attractive total returns, and Neil will provide more colour on this, including a project-by-project update a little later. Moreover, our development programme has the potential to materially add to our current rent roll of £99.9 million, shown here in yellow. Starting with available space at our recently completed and committed schemes in orange, we estimate that this will collectively deliver 29.7 million of additional rent roll based on today's ERVs. Then in green, we show the further 23.8 million of rent that could be achieved from our near-term developments. In total, these projects have the potential to deliver around 54% of incremental rent roll, and that's before taking account of our longer pipeline of potential schemes. So to sum up from me, we have again delivered a strong valuation uplift and further NAV growth, with a particularly notable performance at the East End of Oxford Street. We maintain our stable EPS outlook and our progressive dividend policy. Our rock-solid balance sheet and low-cost firepower will allow us to fund further growth, including delivery of our extensive development programme. So with a positive financial outlook, back to Toby to discuss market trends in more detail.
Thank you, Nick. So let's turn and have a look at conditions in our markets. But first of all, let me just remind you of our strategic positioning. As you can see from the green bars, we have moved through the acquisition phase and are now well into the execution phase, delivering organic growth through investing in our existing portfolio, where the returns on offer are higher than those through competing in the crowded investment market. So then, what are the ideal conditions for this execution phase? First, GDP growth, which drives employment growth, which in turn is a prerequisite for rental growth. And second, robust investment pricing. And today, we have both. So let's start with the macro story. And this slide shows that economic growth expectations have been rising. The bars plot annualised 3-year forecasts, and you can see how they have been revised upwards since September 2013. London is still expected to grow faster than the UK, and as you can see on the right, both business activity and new orders are well above the growth line as the London economy expands. Now, with growth comes new jobs, and London's office-based employment has been rising strongly over recent quarters, as the grey bars show. Crucially, we can expect this trend to continue. As you can see in the bottom left, employment intentions are still well above the growth line, and London is expected to deliver significantly higher job growth through to 2020 than the next two largest European centres of Berlin and Paris. So what then does this mean for leasing activity? Well, we know that business confidence, shown here in orange, is a good leading indicator for take-up, and with such positive employment numbers, we should expect to see leasing trends strengthen further. So it should be no surprise that space under offer is increasing, shown here for the West End, which is currently running at a 25-year high. So what then about supply? Well, despite this demand strength, we think that the supply of new space will actually fall next year before increasing in 2016, as shown on the right of the slide. But even with these increases, new completions will remain way below previous peaks, with the West End core shown in yellow only producing 3 million square feet, or 5% of stock over the next 5 years, and 20% of this will come from GPE. Overlay the fact that in-place Grade A vacancy rates are at or near historic lows, with the West End now beneath 2%, plus the fact that this limited supply needs to house an office population that is both significantly larger, up 57% over the last 20 years, and growing, and you can understand why we remain positive about our leasing prospects. Indeed, we think the office market balance, shown on the left, measuring months' worth of supply, will remain on the landlord side of the rental equilibrium line for a number of years yet, suggesting further growth in rents from here. Independent forecaster PMA and the agents we survey both agree, with growth expected throughout the period in the West End. Against this favourable background, our own average in-place office rent of only £44 a foot looks low, given our core locations and giving us plenty of room for further growth. So, turning to the investment market, and pricing remains strong. The graph top left shows that despite recent gilt yield increases, a large positive spread still exists for the levered buyer, and we expect to see the level of debt to real estate begin to rise again as banks recover their lending appetite, as you can see on the bottom left. But it's equity that drives the investment market, and we are seeing no let-up in capital flowing into London. Demand, shown by the orange bars, is up again and now outweighs the supply of assets currently for sale, the grey bars, by a multiple of 10 times, shown by the blue line. And within the 34 billion of demand, the single biggest increase since our last survey in May comes from sovereign wealth funds, now at 17 billion, shown here in yellow. And these same investors have played a key role over the last few years. The chart bottom right shows that they have accounted for 18.5 billion of investment in London since 2008, more than twice the amount they invested in New York. In fact, more has been invested into our city by this group than into the entire US market over the same period. So the outlook then for our market remains positive. The demand drivers for rents are strongly supportive, whilst the supply response is muted. As a result, we expect rents to rise, particularly in good quality and well-located buildings. For our own portfolio, the guidance for the full year we gave in May looks to be about right. For yields, in the near term, rental growth and the weight of money should offset the 4 amber lights in my list, supporting them trending flat at least. Medium term, as growth is captured, we expect them to rise, but not by much. However, for our own portfolio, our extensive programme of property repositioning could well create further yield compression across a number of properties, and this next chart illustrates the point. It shows our yield in grey against the prime West End market yield in orange, and you can see the margin has reduced from 130 basis points to 80 over the last 4 years. Why is this? Because the quality of our portfolio has improved as we've refurbished and redeveloped. And today, 27% of the portfolio is effectively new versus only 7% in 2010. Now, given our recycling business model, this begs the question as to what next for this proportion of the portfolio, particularly with such competitive investment markets. So what have we been up to? Well, this time last year, you'll remember we turned net sellers. We repeated the message in May, and so far this year, we have been. Since March, we've bought only 21 million in 2 deals. We've sold properties totaling 337 million at a surplus of 10% to book value. We sold a small West End block in Gressy Street off an initial yield of only 3.1% and crystallising a total return of 65.2% over the past 12 months. We've also exercised our put option at 100 Bishopsgate at the pre-agreed price of 15.8 million, and we have now exited this vacant site entirely. We forward sold our development at 12 to 14 Fetter Lane, on which more in a minute, and perhaps most significantly, we kicked off the residential sales programme at Rathbone Square. We received planning permission for our 411,000 square foot scheme in February this year and launched the sales in London in July. To date, of the 142 private apartments, we have exchanged contracts on 129 for a total of 220.2 million, or almost £1,900 a foot capital value, at an average 8.8% ahead of the March valuation. We have a further unit under offer, which would leave us 12 to sell, 8 of which are penthouses and which normally sell later in the process. So with groundworks underway, we expect healthy interest in these last few units as the building takes shape, and more from Neil on our progress here in a minute. At Fetter Lane, we have exchanged contracts to forward sell our long leasehold development off a completed value of 165.8 million, reflecting a net initial yield of 4.5%. We will receive an initial payment of 92.8 million, and all costs to complete will now be paid by the purchaser, with a circa £5 million balancing payment at practical completion. So why have we sold now? Well, because we think the upside potential from here is limited. The scheme is fully pre-let for 20 years, the pricing is strong, with the first rent review more than 6 years away, and we're building under a fixed price contract. Plus, the sale allows us to crystallise a return on capital employed of 83% and a 55% unlevered IRR. So turning then to the larger of our purchases, in July we bought Elm House, pictured here on the right, a tired, empty office building totalling almost 50,000 square feet and adjoining our interest at 200 Gray's Inn Road. Through our GRP JV with BP, we paid 26 million, or £523 a foot, for what is a fantastic opportunity for a complete repositioning, and we are currently working up our proposals. And because of the interplay between this site and our adjoining ownership, we expect to be able to add significant net new area, plus we're doing so in an improving location. Crossrail is minutes away, and the adjacent Mount Pleasant site, marked in yellow, now has planning permission for a major mixed-use redevelopment on the 8.6-acre site. So Elm House represents an exciting addition to our pipeline, but with limited opportunities to buy assets that will deliver more than our existing portfolio, where next for our investing activities? And the answer is that we will continue to invest in our existing portfolio to generate organic growth rates at rates of return that are greater than those available in the market. As you can see from the blue bars, we expect to invest 489 million across our committed and near-term projects between now and early 18, with 58 million of ERV to aim at. We expect to be a net seller, meaning we'll be crystallising surpluses as we go, and the orange bars show exchanged deals yet to complete. But we will always find the odd bolt-on or accretive acquisition. And finally, we will continue investing significant asset management time in both growing and capturing the material reversion across our portfolio, now at 21%. So with so much still to go for during this execution phase, over to Neil for some more detail.
Thank you, Toby. Good morning, everybody. I'll cover this morning asset management activity, which is increasingly positive for performance, and update you on how our well-timed, well-executed developments are driving return. First, let's review the asset management statistics, all of which are moving in the right direction to grow portfolio income. We completed 41 lettings, securing £9.7 million, and market lettings are at an aggregate of 3.1% above ERV. And positive momentum has continued. Since September, we've let £1.2 million with a further £6 million under offer today. The chart on the right shows the valuer's view of portfolio reversion is positive too, at £21 million today, or 21% on contracted rent roll. To help grow portfolio income, we need to maintain high occupancy levels, and we are. 96.3% of income from 67 lease events has been retained, re-let, or required by us for refurbishment. The weighted average unexpired lease term is robust at 6.85 years, and the void rate down, only 2.3% in September. As you can see, the portfolio is in great shape, and the income walk on the right shows the opportunity we have to grow income, not only from developments, as you heard from Nick earlier, but across the business, via our expanding asset management activity. So let's take a look at an example. We completed the development of Wells & Moore in 2009, achieving lettings averaging £43 per foot, totalling £3.9 million per annum, shown by the grey line. We held the asset because we believed in the strong growth prospects of this rent. In 2012, we took space back from double negative after moving them to 160 GreatPortland Street, and income fell to £3 million per annum. On reletting, we achieved £70 and £75 per square foot, shown by the two orange circles, creating new evidence and allowing us to settle the majority tenant's rent review at a net effective rent of £62.50, shown by the blue circle, capturing a major reversion and moving the building income, the grey line, up to £5.4 million today. This increase has propelled asset value up 63% since the first letting, and there's more growth to come. We have another rent review in the building later this year, and Wells & Moore is arguably within the strongest growth submarket in the West End. We have a portfolio brimming with opportunities like Wells & Moore, enabling us to take advantage of supportive market conditions to grow income. Now, let's move on to our development business, which remains one of the most exciting programmes in London. First, this is our usual portfolio pie chart. 54% by area remains in the development programme today, and we're growing the pipeline, shown in grey, replenishing development opportunity as highly lucrative schemes complete. And assets under development remain the star performers, 28% up in the last 12 months. Such performance often driven by positive leasing, a continuing theme for us, as I'll show you in a minute. Plus, our timing looks favourable. So there's lots more performance to come from developments. Now let's review the details. Walmart House is the only completed project since May, and details of all the completed projects are included in the appendix. Walmart's prospects for early leasing look good. The building's 60,000 square feet. We pre-sold the residential, and there's 18,400 square feet of prime retail, the majority of which is let or under offer at a new Zone A high for this pitch, and 38,000 square feet of high-quality offices, all under offer today to a single occupier. GP's return is outstanding at 53.3% profit on cost, an IRR of 25.5%, and income yield of 7.4%. And with Walmart the latest chapter in a long list of successful projects, how do the remaining committed projects look today? Well, following the recent sale of New Fetter Lane, there are 3 remaining fully committed projects, all in the West End, including our largest project to date at Rathbone Square. Taken together, the total area is 521,500 square feet, and the cost to complete is £262.8 million. The value of September 14 ERV is £23.9 million, and the prospects for pre-letting are good, as you'll see in a minute. The total gross development value is £793 million, equating to £1,500 a foot, including the early sales at Rathbone Square, which have secured 28% of this total so far. The yield on cost using the value of September ERV is 6.1%, and the profit is £111.7 million, or 16.4%. With only around 18% of this profit in the September 14 valuation, a lower percentage than secure via the forward sales of Rathbone Square, it's clear there's more profit to accrue to NAV. And as rents grow in market conditions clearly in our favour, we expect the total profit to grow as well. Now, let's look at the near-term prospects in more detail. First, Rathbone Square. This series of images shows the progress to date. The demolition is complete, helping to de-risk our delivery. We've fully committed to the work, securing 70% of the contract price so far, and will be 100% secured by December. We're on programme to complete in Q1 17, so timing looks very good in a West End market starved of quality space. At 411,000 square feet, Rathbone Square has the scale and the quality to act as a catalyst for improvement in this district to the West End, an area we believe has plenty of opportunity still to come. Toby outlined the excellent progress we've made on resi sales so far, and this image shows the office building off the new Garden Square, where the pre-letting prospects are excellent. Which is no surprise with this 34,000 square foot floor plate in a core West End location, only 50 metres from Crossrail, being an exceptionally rare product, and with continuing low supply, we expect rents to grow as the valuer's average rent for the building is £68 per square foot today. And don't forget, to enhance the residential and office, we've 42,000 square feet of retail and restaurants, and with West End retail vacancy close to zero, we anticipate high demand, giving us a further pre-letting opportunity. As Nick said, we've seen strong performance to date because we created something truly unique. And the valuer's expectation of profit on cost today is 17.8%, an IRR of 12.3%, and a yield of 6.6%. Moving into Soho to St Lawrence House, the prospects for securing early income here are noteworthy too. We've commenced full works to this high-quality building. Demolition is underway, and we anticipate completion in Q3 16. When complete, it'll be 92,000 square feet of principally offices, and again, there's an excellent floor plate shown here, which, combined with a first-rate central Soho location, growing tenant demand which is limited future choice, we believe the opportunity for the growth is evident. As with Rathbone, we've seen strong performance since obtaining planning permission, and GP's profit from the valuer's rent and yield is 12.9%, an IRR of 10.9, and a yield of 5.3. Now, moving into the near-term programme, we've 8 projects shown here, and for the future, 12 pipeline projects offering medium and longer-term performance for the business, including our latest acquisition at Elm House in Midtown, where the ownership of next door, as you've seen, is potentially unlocking a very exciting prospect. Taken together, all 20 projects deliver close to 1.7 million square feet of top-quality space. 62% is in the supply-constrained West End, and 29% has planning consent. And for the near term, 90% has planning consent or an application in. So I'll take you through the excellent progress we've made in bringing forward the near-term projects. 7389 Oxford Street is 88,000 square feet, and it's a truly exceptional retail opportunity. We're in detailed discussions with a number of world-class retailers to create a flagship store in this strengthening pitch right next to the Crossrail entrance shown on the bottom right of this image. We intend to commence demolition early next year as vacant possession and planning are secured, with completion set for Q4 17. This project has the location and quality to establish a new Zone A rent for this pitch, and is therefore a cornerstone for the East Oxford Street regeneration story, which will have positive reverberations for a number of future GP projects in the area, such as Oxford House, Directly opposite Crossrail, the building will be 91,000 square feet when complete. We're planning a retail-led reconfiguration. The image shows both the extent and the quality of the new 58-metre long, 8-metre high, double-height retail frontage. We intend to submit a revised planning application to Westminster next year to increase the retail area by around 90%. Oxford House, with 7389, will transform the microlocation into one of London's premier retail pitches. And in keeping with our other developments in the area, the prospects for further growth at Oxford House are marked. At Hanover Square, we've been undertaking a full design review of the 2011 planning consent, first to ensure the building remains appropriate for its target market, and secondly, to maximise the full potential from this once-in-a-lifetime development opportunity. We expect to submit a revised planning application shortly to improve the building aesthetic, extend the urban realm in Hanover Square, and like on Oxford Street, garner the opportunity offered by the upward shift in prime West End retail rents, this time on New Bond Street. Our design proposals will help move values on. The retail rent is £5.25 Zone A today, and the offices are £105 per square foot. We expect both to improve as we move towards a start on site, which, subject to Crossrail station works, could be as early as the second half of 2015. Hanover Square is already an exceptional West End core development opportunity, which should see significant positive momentum, boosted by our design enhancements. Moving outside the West End to 148 Old Street, we've concluded the design and a planning application is in for our major refurbishment proposals shown here. The building will be 152,000 square feet, up 55%, increasing both quality and quantity of space on this underdeveloped site. We're removing the barriers to commencement. We'll get vacant possession in May next year with a target completion of Q4 16. The agent's view on rent is modest at £48, giving room for growth in this emerging London location where pre-letting is becoming more prevalent. So, to sum up on developments, there's lots more to come. Activity is as high as ever. We've delivered highly profitable completions. Committed projects are capturing growth in a market which favours developers with on-site projects. The near-term programme is also positioned for growth, with the pipeline representing a significant opportunity for the medium to longer term. As you've seen, we're prudently managing our development risk and return via the correct mix of sale, either pre or during development, joint ventures, pre-letting and speculative starts, ensuring the portfolio is perfectly placed to deliver more organic growth and a strong total property return for shareholders. And now back to Toby, who will conclude with our outlook.
Thank you, Neil. So, as you've heard this morning, GPE is in great shape, and as I said in May, the next few years for us will be all about exploiting to the full the significant opportunity we have created for the group. 4 messages. First, our strategy is consistent and clear. Repositioning properties to generate rental and capital growth in central London only and with a West End bias, 79% today, and recycling these assets, crystallising profits and reinvesting, always in tune with the cycle. Second, we are delivering our strategy. We're in the execution phase, we're leasing well and churning out strong returns from our portfolio. Third, market conditions are supporting our strategy. London's growth is fueling demand for our space. We expect supply to remain tight, and a deep investment market is giving us liquidity when we need it. And fourth, there is plenty more to come. We have significant reversion to capture. We expect to continue beating the value as ERVs. Our 3.6 million foot portfolio is rich with asset management opportunities to exploit, enabling us to push these ERVs higher. Our 2.2 million foot development programme is stronger than ever, covering 54% of the portfolio and stretching into the 2020s. And with £500 million of capex in the near term, we expect to continue delivering strong returns for the next few years at least. And don't forget, 86% of the entire portfolio will be within a stone's throw of a Crossrail station. So to sum up, GPE is delivering. Our portfolio positioning is excellent. Our positioning in the cycle feels right. We can look forward to rental values rising. We can expect to generate material organic growth, beating IPD. To help us do so, we have a deep and talented team, plus the financial strength to deliver on all of our ambitions. So when you put all of this together, you can understand why we remain confident in our outlook. So there we go. That's the formal part of this morning's proceedings done. If I can get the front bench to move forward. Thank you very much. So we have here to help answer questions all of the presenters this morning, plus Ben Chambers, the investment director. And who would like to go first? There should be some microphones doing the rounds, so if you'd like to use one, it'll make it easier for us to hear you. In the middle there.
Morning, Remke Simon, Kempen. A couple of questions, if I may. First of all, in your comments on your target of being a net seller, does that solely reflect the forward sales of the residential at Rathbone Place, or do you also, on top of that, intend to be a net seller of regular investment assets?
Remco, good question, and the answer to which is absolutely going to be determined by the forward returns we can expect from the assets we own. So if you can go, Rich, if you could go to that yield chart showing the pies on development proportion, this one here. So that 27% that you see there of new product that we have developed, clearly it's had a journey. It's gone from being risk assets where we were developing raw material, where the returns were prospectively very high. You've seen their yields come in, you've seen the rents get repriced up to a higher level, and as you know, our business model is all about recycling that capital into new opportunities. And as you heard from Ben, from Nick and from Neil earlier, £500 million of capex into the near term, likely chance that we'll increase that over the next few years. You might imagine that we will take some of that capital from prospectively lower rates of return from these green assets and employ them into the opportunities we have elsewhere in the portfolio to maximise the return that we're offering shareholders. And that's completely consistent with the game plan that we've been playing over the last few years.
Okay, maybe following up on that. On slide 14, you highlighted that perspective for all the cutbacks and the sales. Your loan to value would be 26%. Now factoring in a bit more development profits, etc., and a bit more sales, that could come down a bit further. Just your thinking on the capital structure, that's a trajectory you're comfortable with, heading towards low 20s, if not slightly lower, or?
I think a couple of comments. Firstly, I think generally businesses are, us included, are more comfortable with lower leverage this cycle than perhaps was the norm last cycle. If you'll remember last cycle, we in fact had the lowest leverage, we think, of any listed REIT when Lehman went down. And that was largely by design. It was because it gave us the capacity for expansion, be that investment in the existing book or acquisitions. As we've talked about this morning, we think the acquisition opportunities are less prevalent than they were a few years ago. It doesn't mean we won't do any. You've seen us buy this year, as we described, twice already. But I think having that capacity at this stage in the cycle is a very good place to be. And we feel about right as it stands today, and we expect it to come down a little bit. But I wouldn't expect to see us do nothing, in the sense that if you look back at our history, you've always seen us be much more active than perhaps charts like this, where we're projecting forward committed, effectively committed business. You might expect to see us more active than this over the next few years. So in answer to the question as to how we feel about gearing at the moment, we feel pretty good.
Excellent. Last question. All the indicators that you mentioned in terms of outlook for rental growth seem to be pretty positive. You're surprised that ERV growth wasn't more than 3.6% for the first half year, or do you expect a pickup in that in the second half and going into 2015?
It's very asset specific when you look at relatively short periods of time. Rich, if you can go to my market outlook slide. We, in May, Remco, you'll remember, we forecast a 5 to 10 on offices. 3.6 puts you right in the middle of that. Would we like it to be higher for the second half? It'll depend on how we do on some of the pre-letting discussions that Neil was referring to, and how we manage to capture some of that reversion that I think the excellent example that he gave at Wells and Moore of the ability to bring revenue growth through asset management. If we're able to pull off some more of those, then yes, we should be towards the top end of our expectations. Are we disappointed with where we are at the moment? No, we're not. It's in line with what we said would happen.
Thanks.
John, right behind.
Good morning. John Lutzius from Green Street. Just a couple of topics. The first, the profit on cost. So for your most recent completing schemes, the profit on cost is a very attractive number. In terms of your projection, I believe your method is to use current rents as opposed to where you think rents will be. So I understand the current profit margin would be conservative on that basis. Can you just give some maybe discussion of what you think a reasonable range of the profit margin might be? And then also, what's a minimum profit margin expectation from your point of view as we look forward?
Okay, let's divide that into two bits. If I address the second part first, and perhaps Neil, you could come back on some of the rent prospects and some of the developments in a little more detail. On the slightly theoretical question of where appropriate profit margins might lie, it depends on the risk inherent in any given scheme. If you're taking full-on speculative risk, you would like it to be 15 plus unlevered. If you are de-risking as you go, Rathbone is a great example, to get more than 15 in current sensibly priced markets is going to be quite difficult. The reason we've been generating, as you can see from this slide, well, in fact, the one you had up before, sorry, Rich, the completed projects have generated so much return over the last few years is because what happens is you freeze the land value at the point of commitment, at your opportunity cost point, and then from there, as you develop through, if the market goes with you, clearly you've got gearing inherent in the development process, rents rising feeds straight through to the valuation, get a bit of yield compression, and the numbers are extremely strong. As you start from scratch, clearly you're starting with a lower expected growth rate, profit margin. Markets then go with you, hopefully. Rents rise, as you've highlighted. We use current rents. You should see those numbers increase. And on that particular point, Neil, are there any particular messages on schemes where we are currently committed on rents that you think we should touch on?
Well, I mean, I think the point is that, and just to echo Toby's point, when we go into a point of commitment on a development, we've got to remember that what then happens at that point in time is the valuers actually mark up that development to the then residual land value, the opportunity cost point that Toby made. Therefore, when we enter into a scheme, and you'll remember from our presentation in May that when we stood up in May, our committed projects did not include Rathbone Square or St Lawrence House, so they're very recently committed schemes. So those mark-to-market in terms of valuations have been done over the course of the last 6 months by the valuers based on the schemes that we've now entered into, and therefore you would always expect to have a margin of profit as you go into this point in the development commitment of around about somewhere between that sort of 12.5% to 20%. And as you mentioned, we are very, very stringent and rigid about the use of current ERVs. The market has proved time and time again that developers who grow their rents ultimately make the wrong investment decision in terms of their capex. Because if you're looking forward in terms of a rental projection, you ultimately therefore commit capital to a project that you probably shouldn't be committing, assuming those rents will come through. So we're very keen to make sure that we apply current day rents, current day yields and current day costs to our developments, and we report the numbers on that basis, which is a very, very important aspect of our checks and balances.
But John, if you look at, so if we have a look at, say, St Lawrence House, or Rathbone for that matter, where the rents being put are current, relatively conservative based upon backward-looking analyses from the valuer, do we stand a better than evens chance of doing better than those rents? Yes, I think we do.
And I'll just add one more thing as well. Clearly, one of the key risks associated with development is achieving planning consent on those schemes. And clearly, at the point that we commit to them, we've got the planning. And so the value that we have created through securing the planning is not reflected in that profit on cost number because it's already been taken in the land value that we use at the point of commitment.
Would you care to throw out a range of what we should expect as you start completing those projects in the future as to where you think the profit margins will come in on an actual basis?
No, I won't give you a range, but what I will say, John, is higher.
Yeah. Okay. And then second question is with respect to the city. Your effective land cost on Bishopgate, I would have thought was relatively modest, but yet you chose to put the project to your share of the project to Brookfield. Can you talk a little bit about that decision, and then maybe separately just about your, you mentioned the concept of risk versus return. Can you just make a couple of comments on how you see risk and return in big city developments relative to what you do in your more typical core business?
Yeah, so Bishopsgate it's actually a very difficult one for us to give you a clear guidance on what the original land cost was, because it predates me by about 40 years. So, and all of us, it's a scheme that we created through the acquisition of a piece of land from Henderson on Chamomile Street in something like that, 2004. So we put the site together, got the planning permission, turned 260,000 square feet into a possible million, roughly, sold half to Brookfield at that point, then sold another 37.5 with the put, as you've described. The reason we put the put is because we negotiated the right to have it on the gamble, if you like, that there would have been a pre-let by now of the entirety. And so the put was there to give us effectively some upside protection in the event that a pre-let was secured for the entirety, and that was the only reason we had it, knowing that selling vacant land effectively, as we did 18 months ago, 2 years ago, wouldn't have given us the best value relative to a pre-let scheme. There has not been a pre-let, therefore it was a relatively straightforward decision for us in the context of retaining, either A, retain 12.5% with a passive position, no pre-let, lots of development capex and risk, or take your money and move it into a position elsewhere in your book where you have complete control, much more in our DNA, as you would imagine. So it was not a difficult decision for us. So in that context, I hope it answers the question as to why we held the put in the first place. It was always going to be a position for us to get out of if there had not been a big pre-let.
Thanks. And then just any comment on your appetite for looking for opportunities in the city today?
Well, I think as you heard from Neil, this is a business operating at full tilt right now. We're doing an enormous amount of development work. When we look at new opportunities, and we are always doing this, and perhaps Ben, you might touch on a couple of things we've looked at in the city. When we look at new opportunities, the key analysis we are making is the prospective rate of return from that new opportunity, with all the risks that we will have difficulty in fully understanding relative to the prospective rate of return of the existing assets we understand fully. And if there is not an appropriate margin between the two, that limited amount of capital goes from the out of the business into the market into the existing assets. And that's the choice we're making right at the moment, because we're looking at nothing that we can find better rates of return than those we can generate internally. And that's why the message this morning is so strongly about organic growth. But I mean, in the city market at the moment, Ben?
Well, I mean, we are looking at a couple of things in the city. I mean, we've looked at some medium-term development opportunities, much smaller than Bishopsgate, much more manageable given our scale. And we've looked at some short-term income that gives us a refurbishment proposition. But in all of those cases, we're coming in slightly behind where the pack is, even in the city. But I think the relative value in the city does interest us if we can find the right opportunities, especially if they're messy assets that give us the ability to use, the development skills, the asset management skills that we have. So, we are actively looking in the city as much as we are across the West End, and also in the South Bank.
Thanks very much.
Thank you, John. Martin, down the front here.
Hi, I'm Martin Allen at Deutsche Bank. I was just wondering, I was slightly surprised you didn't use the occasion of pre-selling New Fetter Lane to commit to new schemes. I just wondered what you're kind of waiting for to make that kind of commitment.
Yeah, it's a fair observation. I think it's a case of choreography as much as anything, because it's pretty tough to get one trade leading naturally onto another in a portfolio where you don't always have complete control of start dates because of existing tenants. So I think what we tend to do is look at it more in the round and say, what's the risk position look like today? Where might it be in 2 years' time, and where has it been over the last 12 months? And if you look at the change in the last 12 months, you've seen, as Nick and Neil highlighted, a big increase in the near-term capex commitments. So it was 50-odd million when we stood up in May for the committed schemes. It's now mid-200s. And that actually squares quite nicely with the Fetter Lane disposition, as you heard. getting them to match exactly is always going to be a challenge. So point number one. Point number two is overall the development programme near term is bigger than it was a couple of years ago. Would we like to bring in some of the other schemes that we've got in the pipeline list, which if you can bring up here, thank you, Richard. You can see there 2 or 3 schemes with 15 and 16 start dates, and clearly those are to do with a combination of planning and or vacant possession. Given market views as we have them today, will we be doing things in Elm House? Clearly yes, so that's likely to find its way into the near-term programme quite soon. Broadwick, most likely. Mortimer House, possibly. There's some interesting tenant discussions to be had there. City Place House, that's looking more likely than less likely. So actually, I think over time you'll see us bring some more into the programme.
Thanks.
Yeah.
Morning, Nick Webb from Exam BNP. On your supply pipeline on slide 21, I guess every 6 months we talk about this, where we look at the pipeline, and you explain to us that you think some of the agents' forecasts are probably too optimistic about the amount that's going to get built. You've always said we think it's going to be lower. Do you think now we've reached the, you've been right up until now, but with all the finance around, the risk appetite clearly growing, is there a risk now that actually these schemes that we were saying, there's no chance they'll get it done, are actually more likely than not to happen, and that those bars could end up being quite a lot larger than your slide suggests?
They could be larger. They could also be smaller. I mean, the history of this cycle has consistently been that people are overestimating the speed with which they can get to market, and that's because planning is a lengthy process that has been taking longer. It's partly financing, but it's a lot to do with planning. If you look at Westminster today, they do an amazing job given the extraordinary conditions they have to operate in. I mean, they have had 100 million per annum taken out of their budget, and they've got another 100 million to go. If you look at the planning team there, they are massively under-resourced. So the idea that suddenly they are going to be able to turn on the tap and say yes, yes, yes to all of the ideas coming out of the development community it's not going to happen. Plus, it takes 3 years at least for stuff to go from an idea at least through to something that's getting built. So I think that the prospects of it being materially higher than this are quite thin. The prospects of it being different to this are extremely high. Could it be 10% higher? Could easily be. Would that make a difference to the market dynamic? Not in the slightest.
Perfect. Thank you.
Any more questions? One more down the front.
Morning, John Stewart from Liberum. Just wanted to take the debate on developments a little bit forward and ask about your development yield appraisals. I think you've in the past indicated that you were factoring in a modest amount of yield expansion into your appraisals. Since then, we've probably seen quite a decent amount of yield compression, and I just wanted to get an idea how your view on that may have changed.
Hasn't changed at all, John. In other words, if you go to that yield chart we were looking at earlier, Rich, with the pies on it, that market call that we've been maintaining has been broadly right in relation to the orange line, except for that dip down, as you can see, the 25 bips. In our own portfolio, we've been creating that compression through the work we've been doing to our projects, as we've described. So as we look from here, our view remains that we gave you in the summer, which is that short term we think it's relatively flat. There'll be some schemes like those we're creating compression that can evidence some inward shift, but overall we think the market is trending roughly flat. I think as investors capture rental growth, who knows what's going to happen with QE, etc. But as investors capture rental growth, we should see some element of expansion over time. Calling that exactly right is impossible. We're not going to get that right. But in our own base case assumptions, in 16 we are assuming some increase. Not much, but we are assuming some increase.
Thank you.
Ben Richard from Credit Suisse. Just a question, you made it very clear about how you mark up land values at the commencement of development to opportunity cost. How would you compare the current values of your non-committed pipeline to the opportunity cost level?
That's a very good but very big question that we probably haven't got time to go through in detail this morning. And the reason for that is every building will be different, because it is a function of the existing cash flows that the existing tenant base are throwing off, the position of the rents, the capex required, the planning position relative to the alternative redeveloped, refurbished proposition. So if you say, take Portman Square, 35 Portman Square, you know, we may get vacant possession in 21. That's a break clause in there. We may well not. It may well be that it goes back to 2026. How you value that opportunity cost, it's a very fluid analysis at this stage, this far ahead of it. At some point, that building will get redeveloped. But you know, what the tenants decide to do will be largely the determining factor as to when that will be, which is why it's a fluid calculation at the moment. It's much easier at an Elm House where clearly it's currently empty and we know we're going to get on and do something short term.
Okay, thanks. And then just a question on the Pollen estate. I think you have a historical interest in that you had. Could you just explain why that wasn't for you? It seemed like an opportunity that fits your skill set. And
that sounds like one for you, Ben.
Thanks, Terry. We have one building on the Pollen estate. We don't have any interest in the Pollen estate. I mean, we did look at it, and we priced it in the same way that we price everything, which is, you know, maintaining discipline, taking a sensible view on what we thought the opportunities were in the assets. And it's fair to say we were a little way behind the purchaser. So, I mean, it was a relative pricing thing. It's a fantastic bunch of assets, but someone was prepared to pay up a lot more for the future potential than we saw.
If you can determine what that future potential is.
Yeah.
I mean, the information provided was next to nothing. They were not legally allowed to give us information.
okay, thank you.
Okay. Well, that's been very good. Thank you very much for those questions. And as ever, we're around for the day and beyond. Thank you for coming along this morning, and see you very soon.